Hello and welcome back, guys. It's Benjamin here, the Royalty King, coming at you with a stock analysis. I know it's been a little while. Hasn't really been any new themes that I wanted to talk about that would warrant a video. Most of what I've been putting out are the thoughts on Substack. So make sure you at least get on the free list for Substack. There's a lot of free content out there, and I think you're really going to enjoy it. Today, I'm going to be talking through a position which illustrates a sector theme that I've been starting to flesh out because I believe, given some recent price movements, it's offering a really, really attractive long-term proposition. So we're going to get into it today, and I'm going to illustrate it via one position, which is WR Berkeley Corporation. It's a name that came up during my recent chat with Uncle Rick. You can check that out again, either on YouTube or Substack. If you want ad-free access, just sign up for free, and it's freely available. So let's get into it, and hopefully I'll be able to illustrate what's on my mind through a position. Disclaimer, of course, nothing I say is advice. Don't be silly, guys. You need to do your own due diligence. This has always been me expressing my opinions and my thoughts in a way that I can document them and go back over time and see how I have done well or how I want to adjust moving forwards. That's all it is. So the investment case that I've had on my mind recently has been obviously capital light inflation beneficiaries are the major theme for me and will be the case for many years. Okay, so if you're sick of it already, nothing, as far as I can tell, is really likely to change over the next at least 10 years. This is very interesting because it's part of a select financial services or insurance firms that is obviously outside of the energy complex and metals complex. So it's not quite a hard asset pecuniary interest by a royalty company. And so what I'm hoping is that I think this is going to give a non-correlated source of alpha that will benefit from all the same reasons as to why I've been so royalty heavy and so energy and metals heavy, but through a completely different sector. It would be an example if we use the framework from our friend James Davolis of Horizon Kinetics. He would describe this as a pillar 2 or indirect inflation beneficiary. And in there you have your financial exchanges, and it may even actually be pillar 3, depending on how you categorize it. Exchanges, financial services, insurance models, or brokerages. These guys are not so much insurance. They are insurance brokers, but they actually take on the operating model of an insurance company and reinsurance. So that's why I'd probably put them in pillar 2, but they might be category 3, depending on how you view it. This is something I would like to get my total exposure well over 10%, okay, and even more. It's just that simply I haven't had a price opportunity that's taken my fancy up until now. So strong return on equity, a long track record of 15% return on invested capital, return on equity, and a decreasing share count. And I believe this and a couple of other names are trading very cheaply on a relative and absolute basis. So this is going to form a theme. Steve from Unemployed Value Degen and I have spoken at length about companies such as Jackson Financial, Abacus Life, Finance of America. They would form, I guess, his triumvirate of how to play the silver tsunami, which is roughly a $75 trillion economy in and of itself. I think that WR Berkeley, it's less age specific than, say, a Jackson Financial or Finance of America, really catering to that economy. But they will obviously do very well. That economy will make up a large part of their customer base. And I think that this also, through their more general or property and casualty insurance, is a really, really, really good business. And Uncle Rick actually has spoken about that in private with me, about his private interest in the insurance business and how much he really likes it, in the fact that it gives you basically a negative cost of capital and allows you to compound that tax protected over a long period of time. So let's take a look and we'll see what you guys think. I'm going to show you what I think. This is a very brief executive summary. I'm going to keep the videos brief and deep dives for Substack. Founded, it's been around several decades, Greenwich, Connecticut, kind of like a ground zero for a lot of hedge funds and financial firms. Property and casualty. So not so much, say, silver tsunami, annuities, reverse mortgages, but more broad category. This guy, W. Berkeley, owns 21% of the stocks. He's got skin in the game, very good long-term record. This will be a part of why I've chosen to increase my position in WR Berkeley versus some of the other names that I might mention, like Fidelity and MetLife and those guys. This guy's got skin in the game, and I think he's been a good steward of company capital and is a very shareholder-friendly director. So, US-based property and casualty insurance. Company operates worldwide, more than 50 businesses in a very decentralized model, which I really like. Here we've got what was my, when I was doing this, this was the current price. It was a couple of days ago. And I'm moving on the screen. Sorry, I'm getting used to using Riverside so that you could see the numbers down below. I'm going to hopefully figure that out. I can't move my face away from it. Maybe you guys can see now. Hopefully you can. I can see. All I wanted to point out was this thing is trading at roughly 10 times next month's free cash flow, and the whole enterprise is trading at twice the expected revenues. Okay, it's very, very cheap for a company of this size. It's a $26 billion company. It's not a small cap by any means. It's certainly not a shitco. So I think that to me, I start to take into account, hang on a minute, this is a high quality business, a big business, not a small company, with management alignment, and I can get this on a relatively cheap valuation. Look at the numbers there in terms of return on invested capital, return on equity, very good track record. PE 16. I don't like using PE. That's kind of for novices, honestly, but I'll use it to give a quick and dirty analysis. S&P 500 is trading almost twice that. Since the recent sell-off, it's come down a little bit. But you've got to ask yourself, that PE of about 14 to 16 has been a long-term average for the S&P, and 10 times the cash flows. If you're getting a 10% free cash flow yield for a company that buys back shares, has a very strong shareholder return program, and a long and proven track record of compounding with a high return on equity of over 20%, at a company that size, it's obviously impressive. Why would I want to come down the quality trail when something like this is on offer? So, okay, I think if I come in and out of the windows here, I'm getting the hang of this thing. Bear with me. So I wanted to talk about this return on equity. Obviously, as I've said, long term, if you go back over 20 years now, you're getting close to 14.5%, 15%, let's call it. And I've been flogging this quote from Charlie Munger, but it just time and time again turns out to be true. Your long-term predictable return on investment will be more or less equal to the return on capital or return on assets, in this case, return on equity, because of the intellectual type nature of the business. It's not an asset-heavy business by any means. So return on equity is a fairly good one to use, in my opinion. And if you take a look at this light blue line, you'll see that's the total shares outstanding. So they've been delivering, returning on the equity, and they've been shrinking the share count over time. So very, very shareholder value-friendly management. And no surprise, what do you know? The main guy owns over 20% of the company. So this is all starting to line up pretty well from my perspective. Okay. And what do you know? If you take a look over the past 20 years, the total return on offer, if you had been a long-term holder of WR Berkeley, take a look down here at the compounded annual growth rate. Looks suspiciously similar to the long-term return on equity over that same period, doesn't it? And that's no coincidence. So this is something that I'm just trying to really drill into my own mind. I've known it for 10 years. And I just want to get better at applying what I know. It's not about knowing more necessarily for me now in my investment journey. It's about applying what I know, not getting distracted by bright shining objects, and just hanging out where and with whom I've made money in the past. Okie doke, here are some relative valuations. So you can see in this, peer group, I think there's some decent value on offer. If you take a look at the return on equity, obviously all of these guys are above double digits. That's what I've looked for, and they've got decent track records. Price to free cash flow, Fidelity appears to be the cheapest, and then WR Berkeley behind that. Fidelity and WR Berkeley are different in the sense that WR Berkeley's got the main guy with more skin in the game, and they do offer different products. I've taken a very small starter position in Erie and Fidelity because I think that I want to do some more due diligence. WR Berkeley is already a 1% position, and I'm going to be looking to grow it opportunistically over the coming months. Okay. Growth at the top line and margin expansion. Very, very, very good sign. So if we take a look at part of what has already been and what is expected to come, you got to be careful extrapolating out into the future, obviously. But given the recurring, boring, consistent nature of this business, I think extrapolating out over 3 to 4 years is certainly, it's not extreme by any means. And so if we can say, look, generally speaking, the top line is going to compound 8 to 9%, somewhere around there. The net income can compound above that, and the earnings can compound above that with a few financial and accounting wizardry. If the earnings and the net income are growing at a faster rate than the top line, it's suggesting they're able to expand their margins. And that is exactly what I want in a highly inflationary environment. Okay. Return on equity and the net income you've seen since COVID. So we're in a new paradigm, basically. COVID was the change of an old regime into a new macroeconomic regime. How has this business performed given that change in time frame and change in macro outlook? So far, it's averaging 18% return on equity. If we stop and we ask ourselves if that makes sense just via the sniff test, of course it does, because insurance, are we not going to pay, are businesses and individuals going to stop paying their insurance in an inflationary environment? No. Come what may, this is a juggernaut of an industry. It's unexciting, it's not sexy, it's boring, and at this point in my life, it's exactly what I want. This is able to perform in low and high inflationary environments. It's not going to make it's not going to have a deleterious effect on the underlying operations if I come to that conclusion. The customers, insurance customers, they're rusted on. Yes, there's more ability to change these days with online technology and that sort of thing, but these guys have been around for a long time. They're obviously very good at what they do in terms of the growth numbers that you've seen. That's not by accident. So I think that this is a really good business model that will play a key role in the portfolio for those reasons. Net income has done very, very well since COVID. So obviously they're able to thrive. And there's been quite a few, I guess, natural disasters in the US since COVID. Now, this speaks to that point. Here, you're really just looking at industry event to loss surplus and how conservative these guys are in terms of when they have payouts, how much of that surplus does that really affect? So it's extremely conservatively run, which is exactly what you want for an insurance business. You don't want to be picking up pennies in front of a steamroller, a disaster come along, and their strategy has been running a little too close to the red line, let's say. Okay, so I thought this is really incredible. No one, myself included, I think really knew much about this or would have guessed that the long-term gain in the book value of the corporation has compounded with dividends reinvested in the same light as the graphic on the left. So 122x since 1971, I think it was 1972, 1971, which again was an inflationary decade, if you think about it. I think that's quite incredible. I'd be interested to see off the top of my head whether that compares with Texas specific. It might even be better. I'm going to have a look at that in another episode perhaps. But if you look at the cumulative growth versus the S&P over the beginning of the stagflationary decade of the 70s, all the way through different business cycles through the 80s and the 90s and the early 2000s, this thing has been able to do very, very well indeed, which is a further vote of confidence to the robust and anti-fragile nature of the business. Inside ownership, pretty straightforward. Here you've got W.R. Berkeley Jr. himself in terms of his ownership of the company, and it's over 21% in total. So that's it for today, guys. I wanted to keep it brief. I've kept it under 15 minutes. I'm long W.R. Berkeley. It's quality, it's predictable, it is an inflation beneficiary, it's asset light, and it's growing its net asset value. We're getting paid as an investor to wait with, in my opinion, very little risk. I've currently got it as a bit over a 1% weighting, and I want to bump that up potentially to a 5% weighting, depending on how I see the other peers in that sector. So I hope this was useful. I hope you got the hang of it. And I hope it comes out the same way that I've recorded it from my end. I hope you guys have a nice viewing experience. Thank you very much for tuning in. Be sure to check out the Substack for ad-free access and deep dives. That's where I'm spending most of my time and where you'll get, I guess, the crux of the content more regularly than YouTube. Take care, and I'll see you in another episode shortly. Drop your comments below, like and subscribe, and help me out if you got any value. Thank you.